As you may have noticed, major equity indices across the board have recently dropped 5 to 8% from their previous highs. The damage is highly concentrated in tech-heavy exchanges, where red indicators and multi-point drops are actively flashing across the boards. Yet, looking at the official macroeconomic data presents a paradox. On paper, the economy appears perfectly stable. Initial jobless claims are hovering around a safe 213,000. Corporate layoffs and total discharges continue to sit below their pre-pandemic averages. This stability projects a strong sense of security across the broader market. Retail investors and junior analysts frequently fall into an analytical trap here. They wait for this lagging labor data to confirm whether a localized market drop is actually dangerous. In reality, severe asset price declines actively drive the very economic contractions that they are often mistakenly thought to follow. By filtering out lagging labor reports and directly mapping market structure and global liquidity, we can precisely locate our position in a late-stage business cycle long before a recession is ever declared. We start by identifying a lower high in the charts. A lower high is a peak in asset price that fails to reach the level of the previous peak, signaling waning upward momentum and serving as an early warning of market fatigue. This chart shows the tech sector's recent behavior. It reached a distinct peak, dropped, and failed to climb back to that high. Compare this directly to 2021 and 2022. The exact same lower high structural pattern materialized right before a major sell-off. While tech shows weakness, industrial stocks have pushed upward to print higher highs. Tech failing while heavy industrials climb is the textbook hallmark of a midterm year distribution phase. Institutional capital is rotating out of growth and into value. Historically, the third quarter of these midterm years acts as a primary window for extreme equity weakness. The current 5 to 8% market drop is a historically scheduled correction inherent to this specific phase of the business cycle. Analyzing raw stock prices in a vacuum is misleading unless you adjust those prices for the total supply of money circulating in the financial system. To normalize the data, we calculate the S&P 500 divided by M2. M2 is a measure of the money supply that include cash, checking deposits, and easily convertible near money. This chart displays the current S&P to M2 ratio. Watch as it climbs, hits a massive macroeconomic resistance ceiling, and sharply deflects downward. Pulling back to the late 1990s reveals a historical analog hitting the exact same resistance band. The 1998 rejection triggered a brutal 20% correction. That drop didn't break the system. It found support, consolidated, and eventually rallied to new highs. A 10 to 20% drop today is a necessary technical reset required to test structural support before the market can move forward. At what specific point does a routine 10% market correction trigger an actual economic recession? The required trigger relies on duration. The market drop must become durable, meaning asset prices stay deeply suppressed for an extended period of time. This flowchart illustrates the mechanics. Prolonged depressed asset prices destroy corporate collateral and squeeze company balance sheets. To preserve dwindling capital under this squeeze, corporations enact hiring freezes, causing overall job openings to plummet. The final capitulation phase hits when companies are forced into active workforce reductions. Returning to the initial jobless claims number of 213,000, we can see exactly where we are in the cycle. We are stuck safely at step 2. Historically, this negative feedback loop isn't fully active until jobless claims breach a hard macroeconomic threshold of 300,000. While falling job openings show high systemic fragility, the absence of mass layoffs indicates the final recessionary trigger remains untouched for now. Tracking global liquidity provides another leading signal. The money supply has been uncomfortably tight for a prolonged period. An aggressively rallying US dollar tightens global financial conditions further, actively starving high-risk assets of capital. We can observe this through risk curve behavior. The risk curve is a spectrum ranking assets by their potential return and corresponding volatility. In an early cycle, abundant liquidity pushes capital far out into highly speculative assets. This diagram maps the late cycle reversal. As liquidity dries up, capital systematically flees from high-risk speculation toward absolute safety. At the extreme edge of the curve, Bitcoin is down roughly 18% against the US dollar this year. Capital is bypassing the broader equity market to move directly into tangible commodities, leaving Bitcoin down 29% against gold. The capital flight tracks even further down the risk curve into classic late-cycle safe havens, flowing directly into the energy sector. Speculative tech is abandoned for heavy industry. Specific manufacturing stocks have rallied up to 70% in recent months. The sustained underperformance of high beta assets relative to energy and manufacturing signals that institutional capital has transitioned into a late-cycle defensive posture. All of this brings us back to the core tension, the agonizing wait for an official recession to be announced on the news. Official recessions are declared by the NBER, the National Bureau of Economic Research. Their entire data-gathering process relies on hard economic data that is inherently backward-looking and heavily delayed. This timeline charts a typical cycle. NBER requires months of consecutive data, placing the official announcement at the end. However, the stock market bottoms earlier. Due to reporting lag, the market finds its floor an average of 15 days before the recession announcement. Selling your stocks the moment you finally hear the word recession from a government bureau usually guarantees you're selling at the market's exact bottom. Survival in a late-stage business cycle requires ignoring lagging macroeconomic headlines. You must trust the leading signals of market structure, liquidity rotation, and asset pricing.